We think the market is probably close to forming, at a minimum, an intermediate top, a period of consolidation, and likely to go and at a minimum retest the lows of what was that, early April, about a month ago.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week for another weekly market recap. This week, featuring my good friend, the pungent portfolio manager, Michael Lebowitz. Mike, how you doing?
I'm doing great. Pungent?
Pungent, yeah, it's actually not really an adjective for you. It's much more for me this week. My wife and I, we live on the kind of outskirts of town. We paid the skunk tax this morning when we let our dogs out at dawn.
Oh,
So it's been a fun morning dealing with that here. Yeah, so things are still quite pungent here in the home office.
well, good thing YouTube hasn't come out with aromas in addition to the video
Yes,
and
with
audio.
smell-o-vision. Yeah, it's a good thing
Television.
smell-o-vision hasn't really become a thing yet. Yeah. All right. Well, look, things are starting to smell better on Wall Street versus, the rough April that we had. I will say, Michael, that your colleague, your co-portfolio manager, Lance Roberts, has been saying that, he expects the volatility we've seen from the start of this year to continue over the next quarter or two. And so he has said, his advice has been more sort of sell the rips. So I'm curious, are you guys selling or positioning to sell this current rip that we're seeing in the markets?
So yeah, I mean, I remember we were talking about this kind of at the end of last year, beginning of this year I was on, and my prognosis was that this was going to be the year of the roller coaster. We start and end at the same place, but there's some thrills along the way. I didn't expect the roller coaster to be this scary, but nonetheless, this is the roller coaster we were kind of expecting. And as the year has progressed, we got our long-term sell signals. Those are kind of tried and tested, and we really use those to help guide us. So once those triggered, they happen to trigger towards the bottom of the market a month or two ago. And the market was grossly oversold at that point. So we were in risk reduction mode, but very slow to reduce risk because the market was so oversold that even if the world was coming to an end, we were going to get a bounce first and get better prices in which to unload stock or add shorts, or however we were going to reduce exposure. And sure enough, we got a bounce down there, and it's been a relatively durable bounce so far, lasting over a month. In fact, we've reversed the losses since Trump announced his tariffs. So that's positive. And we have been reducing. We're down to roughly 45% equities out of 60. So we've cut basically a quarter of the equities that we have. In, three different ways we do that. We can just outright sell securities. We can add short exposure via an ETF, which we've done, and we can change the composition of what we hold. So we might want to own more staples and less technology, more utilities, less communications. This time's a little different because of tariffs. So maybe you want to own less companies that are heavily dependent on China or other countries. So, but same concept. We've reduced our exposure into this rip. Our last trade happening a couple days ago, which now has us kind of where we want to be. And we think the market is probably close to forming, at a minimum, an intermediate top, a period of consolidation, and likely to go and at a minimum retest the lows of what was that, early April, about a month ago.
Okay. So you mentioned there's sort of three strategies you could use: reduce equity exposure, actually increase your shorts, or change the mix. It sounds like you've definitely done the first. Lance has mentioned in previous weeks that you were increasing or you're adding to shorts, this small position, but we're adding to it. are you also are you doing all three or just the first two, or
We've
what are you guys
actually
doing?
we've actually done all three a little bit on the the biggest one was reduced exposure by about 10%. We added about 5% of short positions, which basically offset exposure. And we recently bought a couple energy stocks that were very cheap. We added Procter Gamble a while back, so more conservative things to offset some of the more high beta stocks that we had sold or high beta sectors that we had sold. So really a combination of all three kind of gets us to where our portfolio is today, which again is conservative. And we're bracing for how these tariffs are going to actually impact the economy. I think we still have yet to see that.
Right. Okay. And I'm going to want to talk with you about that in just a minute here. All right. Well, look, since we're sort of on the subject of the markets and sell signals and stuff like that, maybe we should bring up the S&P just for a moment and do the quick technical analysis check, just to get a sense for what the data is saying to us. And as you said, Michael, it sounds like you're saying you're feeling like the rally that we've had is getting long in the tooth here. And not only might it top out, but you could see it potentially reversing and returning to the lows, or at least
Right.
near them.
So let me share my screen here. So S&P 500, and you can see this dotted line was a point of support. It bounced off it twice. It fell through, and it didn't really, it was a little bit of resistance. We thought it would be more resistance, and it still may be. I mean, we haven't cleared it by that much. That's one line in the sand. And that dotted line, in addition to being support multiple times, was also the 50% retracement. So it basically cuts the middle between the peak and the trough. You can see there have also been moving averages along the way that we've gone through. The 20-day in, I guess that's red, the 50-day in blue, and then straight ahead you have the 200-day and the in black and the 100-day in yellow. And my guess is that somewhere where they are, which is between 5750 for the 200 and roughly 5800 for the 100, that's probably the natural peak if we get that far. And you can see that also aligns with that the peak in that first, the market started selling off and then it rallied for about a week and a half. It also aligns with that peak. So that would be a natural point where this market stalls out and potentially starts testing those moving averages on the way back down. So that's what we're looking at again, but we could break through. We could get good news. The market may not care about tariffs. A lot can happen. The Fed could cut rates. There's all kinds of possibilities, which we're saying will not happen. But that's the resistance. And if we start breaking through there, we're going to go back and start reassessing our stance on the market, but potentially become less conservative, wait for our longer term indicators to flip back around to a buy signal, and then potentially even get aggressive. So there's kind of three roadmaps that we have that we've thought about. Let me flip to that. So on the screen, these are kind of the three roadmaps that we think could play out this year. B is what we think is the most likely scenario, the roller coaster before everything kind of gets settled down and then we can start rallying again. A is the opportunistic or optimistic scenario that I just kind of laid out, that we get through resistance, that there's good news, that the economy holds up well. And some of it may be that Trump starts releasing his tax plans, his deregulation, other things that can really stimulate the economy and are good for corporate bottom lines. And then scenario C is where the tariffs really do have a big impact on the economy, and we go into something like what we saw in 2022, where we're just setting lower highs and lower lows, kind of a stair step downwards. So that's kind of the three scenarios we see, but we still think scenario B, which is a roller coaster for most of this year, is the likely scenario before eventually going back towards the highs, whether that's later this year or next year. It's too early to tell.
It's a really helpful construct here. And I'll say, Michael, I would say the majority of people that I've interviewed recently are placing their chips on B as well, which is this sort of frustrating chop between now and fall. Maybe sort of retesting the lows, but not getting too much further beneath them,
Right.
and really just kind of, grinding the speculation out of the market. And then the market finds a footing later in the year, perhaps at a time where the economy maybe start improving because of some of the policy decisions that are being laid right now. Um, and obviously, we've got some people that are more pessimistic than that. Could see the economy going into recession this year. So that's the C wave where things go to new lows before they recover. But then, as you said, like I'm going to ask you about this in a bit. Like this market has so many non-market potential catalysts out there. Like we could announce a trade deal with China next week, right? And that would take a lot of uncertainty out of there, and that could very quickly get us to the A path. So it is kind of rough here that you've got to play for each. You have to leave the door open to each one of those potentialities while you're managing capital.
Yeah, and the problem, the issue is what's a trade deal? So I've read a decent amount on this, and it takes years for these trade deals to occur. So I think when we talk about trade deal, what we're really talking about is a trade term sheet, a basic set of principles that both parties agree to.
Right. They're calling in the administration is saying memoranda of understanding. That's what they're really hoping to strike in the near term.
Right. And it's very possible we get, I assume we will get some of them. Japan's most likely.
India.
Uh, I assume we get them, but it's unclear what happens with tariffs between when you get that kind of term sheet and possibly a year, 2 or 3 before you really get an agreement. And that's where just because we get these term sheets doesn't mean we're on safe ground yet either. You can all of a sudden negotiations could fall apart and the deal can go away. So I think we're going to be on pins and needles for a while, even if we get agreements.
Yeah, I agree. Although I think that the biggest uncertainty people have right now is the tariffs. How much of Trump's big poster board chart is going to be applied. And
Mhm.
I think as long as at least if I'm hearing the administration correctly, if memoranda of understanding are struck, then the tariffs are going to be whatever the memorandum, kind of agrees they're going to be. So a big part of the uncertainty will get removed. Now, could it get applied back on if the trade deal falls apart later on? Sure.
Right.
But that's true at any point with any country, really, to be
Right.
honest. Yeah.
And honestly, I think this is all about China. At the end of the day,
I'm
we
right there
have
with you.
we have decent deals with Canada and Mexico. They're not extremely onerous. Japan, I think, will come to the table quickly, and then you're left with China, and China's playing hardball too. So I think that's the tricky one, and the markets will, to some degree, move with with the China negotiations. If they're going well, the market will generally trade better, and vice versa. So that's the one to pay close attention to.
Attention to. Well, so I totally agree, and I've talked so much in this channel about it recently. I won't rehash everything, but it seems clearer and clearer, at least to me, that this whole kind of put tariffs on everybody all at once was a strategy from Trump to try to get the rest of the world onto Team America very quickly to apply maximum pressure on China here. But in terms of the markets, um, I mean, I do imagine that we'll see some relief in the market as each new trade deal with a major company is struck, or at least these memoranda are struck, right?
Mhm.
So, Japan, India, whatever, the administration is saying they're focused on the big 18 countries right now, and that they're telling us they're all really close. Now they better be, because they'll disappoint the markets if we have a few more weeks go by with nothing announced. But if we start getting a deal or two a week with a big country, China and India and Indonesia or whatever, I mean that will be providing some upward lift to markets. And then even today, the markets are up over 1% today because, well, probably for a number of reasons, but a headline today is that China's just announced the door is open to talks, which is being taken as a little bit of a, not a capitulation, but a little bit of a de-escalation. That's the word that the administration says they're looking to see from
Right.
China. So, reason why I mention all that is, you're looking at the technical, as you're saying, you think more likely than not right now, the market's going to top out and then go back to retest the lows. But that could get thwarted if we get some really good news on the trade front in the interim, correct?
Absolutely. And I think it's also, while there are a lot of people that want to buy the dip and buy stocks on, you know, on discount, which, typically is a good idea, there's a lot of trapped longs as well. People that have held this market for a while, they've watched their portfolio wealth drop by 20, 10, 20, 30, 40% for some of them, and they've gotten a chunk of it back. And they're like, you know what? Now it's time. I got to take some cards off the table so I can sleep at night. And you have those pent up kind of trap longs that I think will probably start selling in this general vicinity. So at a minimum, it just creates an area of resistance, consolidation at and around current levels. Possible that it's not as strong as I think it is, and the bulls can just push this thing right up through. But there also may be enough pent up longs that all they need is one more day, one more down, S&P down 150 day to scare them into action. So, you know, again, just buckle up because this is going to be a roller coaster.
Yeah,
And
tricky times. And sorry, let me just put this other thing into the mix, which is we're now in earnings season, so companies are able to start buying back their stocks. So that's
that's a
another
big deal.
positive side here, right? So there's a lot of kind of cross currents going on right now.
Right. For the most part, the largest companies are done. So Apple and Amazon reported last night, and the rest of the big boys reported in a prior week or two. So they are now able to buy back stock. A lot of them re-upped the amount they can buy back. And because they've been out of the market for a few weeks, they see their stocks at lower prices and may be more tempted to kind of front load how much they buy back versus kind of more steady as they typically do. So that's a potential driver, at least, for the next few weeks.
Okay. And again, there's this, you know, heterogeneous soup here, but all things being equal, you think the odds are to the downside from here in the relatively near term.
I think very short term, I think we just kind of bounce around these kind of levels where we're at now, play around with that resistance level. But I do think that over the course of the year, we'll at least retest that low once, possibly more.
Okay. I'm going to ask you this question. I've asked it to Lance, so I know his answer, but I'm just curious to hear yours. So, again, we're in this period of time where there's so many non-market potential catalysts for market action. What if we get a Ukraine-Russia truce? What impact do you think that'll have on markets?
I don't think it. I mean, I think the market is sort of pricing that in. I think we all know it's coming. The terms we don't know, but I'm not sure the terms matter to the market, assuming that that it ends the war. I think one of the positives that could come of it from the United States is this rare earth agreement with Ukraine, which I believe has already been signed. So that on the margin may ease our dependence from China, which may bring China, takes away some leverage from China in the trade talks. So that's just one thing to consider. But I don't think there's much to this Russia Ukraine thing anymore. Obviously, if we lift restrictions on Russian oil, it puts more oil on the market, which, again, price of oil has fallen decently. It could put more
Mhm.
pressure to lower prices, which is not good for the oil companies, but beneficial for just about every other industry and consumers. So, those are kind of some secondary considerations.
Okay. I do want to talk about oil with you in a moment, but so just so you know, your opinion is very consistent with that of your co-portfolio manager there. Lance
But
doesn't feel like it feels like it's mostly already priced in, and then a truce, isn't going to really move the needle very much. Um, okay, well, let's cross our fingers and still hope we get it though. Um, so you mentioned, or we mentioned that earnings is underway. What has it told us so far? Yeah, I know from the Mag 7, it's definitely been a mixed bag. We've had big beats with companies like Meta and Microsoft, but we've had some disappointments like with Apple and Amazon. Um, so what are we learning, if anything, so far from what we're hearing from companies?
So a lot of disappointments have more been in the outlooks. And some companies have been more conservative in their outlooks because they just don't know what's happening. And here's the problem is that earnings, this is earnings from the most companies from January through March. So and this is an economic theme I'm sure we're going to talk about a little bit later. The impact hasn't been felt yet. It certainly wasn't felt prior to March 31st. So it's kind of the earnings are kind of stale news. And
Right, because
a
they're
lot
all
of economic,
pre-Liberation Day results. Yeah,
I mean, right. But when was Liberation Day? Mid-March? I can't remember, but
I think it was April, wasn't it?
or April even. So
Yeah,
it
I'm saying
wasn't even a
it's not included
factor.
in Q1. Yeah.
Okay, so it wasn't even a factor in Q1 earnings. Obviously, there was some front running buying in advance of it, which affected earnings, which should have been positive. But the impact hasn't been felt. So that's stale news. The one takeaway, which we talked about in our daily commentary, I think it was today, if not yesterday, was companies like McDonald's, Chipotle, Starbucks. They are all saw same store sales. That's a lot of S's. Same store sales fall for the first time for most of them since 2020, when obviously that people weren't going to those kind of places. Those are all very low end price establishments. McDonald's, Starbucks, Chipotle. So I think some of the takeaway for me is that the low end, the lower, lower middle class, lower classes income earners are starting to struggle a little bit. I think it's telling me that those kind of companies don't have as much control over price anymore, pricing power as they had prior to this. They can't just raise prices with inflation and expect consumers to just pay it, meaning that I'm concerned that some of those type of companies are going to have weaker margins if they want to maintain market share. And if they don't want to maintain market share, they're going to lose revenue. Um,
Right. Well,
so
and I think part of that is because, I mean, if these tariffs go through, they're not going to be able to pass the price of them along to their customers because the customers can't
right.
absorb them, right? So
Right,
they're
right. And that's the bigger picture item is it's not just McDonald's and Starbucks. That's probably going to be a story, maybe not Rolex or Prada, but for the large majority of stuff more normal schmoes like us buy, that's going to be a bigger issue. That 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 if there's a 10% tariff, they may only be able to pass on 3 or 4 or 5%, and they're going to have to eat 5%. And if they have to eat 5% of it, it cuts their margins. How do they react? Do they lay off employees? Do they stop future expansion? Do they, they can react a number of different ways, but they're under intense pressure to keep profits up.
yeah. Well, so let me ask you this then. So, you had your chart there of the different scenarios. Your default scenario, the middle one, the B one, I don't believe, you tell me, but I don't believe you necessarily think that there's a recession in that scenario, or at least if there is one, it's shallow and brief. Um, uh, but we don't know, right? I mean, and there's a lot of uncertainty out there right now, both in terms of, hey, what type of tariffs do materialize from here, right? And without knowing, what we're hearing, at least from a lot of CEOs, is that they're just freezing their CapEx spending right now, right? They're like, I just don't know what to spend on because I don't know what the future is going to be like, right? And so the longer that uncertainty continues, the more kind of corrosive that inaction becomes, and
Exactly.
it's beginning to guarantee that you're going to have less economic activity because less stuff is getting done, right? So you've got that risk, right? And then to your point, even tariffs aside, we're seeing weakness in the consumer sector, right? You just mentioned that the lower tier is showing signs. You mentioned some signs of their reduced spending. And we've seen reports from the luxury manufacturers of late that they're seeing some weakness in that affluent consumer who's kind of been propping up the averages on retail
Right.
spending. So it's kind of like you've got this already weakening consumer that's now, and that's going to be potentially impacting consumer spending going forward. And then you have the reduction in CapEx spending right now, which will basically compound with that. So I'm just curious, what kind of odds do you give a recession this year, given what you see so far?
Right now, 20, 30%, I don't know. It's hard to put a number on it. But every day that goes, if you were to ask me every day and we don't have trade agreements and we don't have better consumer sentiment, those odds start increasing and they probably start increasing rapidly. So I think the administration is under pressure to get tariffs behind us and to get some of these other agenda items to the forefront because that is the risk. And the risk, look, we could be in a recession now. Quite often we're in a recession and recessions are backdated. So
Right.
we could very easily be in one and not know we're in one for 9 months. And that's a risk that we're taking. Look, first quarter GDP was negative, but
Right.
it was a screwy number. Imports, the imports versus exports subtracted about 4%,
Yeah, they,
4 point,
they heavily distorted it. Yeah.
yeah, 4.5, 4.8%, something from it. But then private inventories were much higher than normal. That's the stockpiling. And when you kind of strip all that stuff out, it looks like it was running about upper 1%, which is nice, but it continues to point to weakening economic activity, which forget tariffs, forget Trump, that was the trend already, right? The stimulus was wearing down, and we were kind of just going back towards our normal 2%-ish growth rate. So we're not working with a high baseline of growth as we were a couple of years ago. We're working
Right.
from a lower growth level.
And sorry to interrupt, but is the low price of oil right now sending a potential signal too that just demand, commercial industrial demand is
I mean,
just lower?
it's supply and demand.
Right.
And we just heard from OPEC. One of the things that really knocked it off earlier this week was that OPEC said they're not really thinking about cutting production,
Cutting
which,
production. But just to be clear, that knocked the price from 60 to 50 something for a
of
bit. I mean,
course,
it was still pretty low at 60.
right, right. So, yeah, I'm sure demand is coming off. We know that air travel is starting to see some issues. The big airlines all mention it in their earnings reports that they're seeing lesser international travel. And they're certainly seeing less government travel, which is affecting them, and that that has a impact on the price of energy. So, you know, energy, yes, it is a tell. It's not the only tell, but it is a tell. And um, but a lot of the other economic data is not clearly showing, other than sentiment. Sentiment is horrendous, whether it's, the surveys like the ISM surveys of corporate managers or consumer, University of Michigan, the Conference Board. Those are telling you that we're at levels that are associated with deep recessions.
Right.
But it doesn't matter. I can think we're in a recession, but if I go to the restaurant the same number of times and I go to the movies and I still buy a car every 4 years, it's not a recession because spending is still occurring, no
Yeah, and
matter what we think.
this is what I've been hearing Treasury Secretary Scott Bessent saying a lot, which is the reporters have been asking him, hey, we're getting these bad sentiment reports and CEOs are reporting that they're worried and consumers are reporting that they're worried. And Scott's like, well, I've been in the investing game for a long time, and I've really learned to kind of discount the surveys and really just look at the data. People don't necessarily always say what they're doing. What they say isn't always a reflection of what they're doing. And I look at the data, people are still spending, right?
Right.
Now, in theory, sentiment should, have some impact on future behavior, but again, not always. And what's interesting here on the day we're talking, um, on the resilient side for the economy, we just got the latest payroll numbers.
Right.
Right. And they were pretty good. I mean, they were quite good versus expectations. I think it was like a 2 sigma beat. It came in at 177 thousand new jobs, and that was above, I think, the highest estimate. So, despite this uncertainty around tariffs, despite the sentiment that you've talked about, companies are not yet, at least, laying off people at enough scale to matter. And of
Right.
course, we can debate back and forth the quality of these numbers, but it's the data we have right now. And in the data, it does show some of the impacts of Doge. You saw government jobs they did go down.
Mhm.
But you saw a huge rebound in jobs for domestic-born people. We talked about in the past that pretty much all the job growth was in either government jobs or part-time jobs going to foreign-born workers. So we're seeing some, I think, more healthy trends in this recent data. Uh, you know, who knows if it's just a one-time blip or not, but it's hard to go into recession without weakness in the jobs market. And unemployment rate is still unchanged at 4.2%.
My concern is that every piece of economic data, that just about every piece that we see, is not real time. It's a month or two stale, sometimes
Hmm.
even more, and it often gets revised. So the problem with so the ADP job number was only 68,000. That's nice. It's good that it's growing, but it's weak. It's very
Right.
weak. They're using actual results. They don't, that's all private sector. So they get their data from all the companies that use their service and they report what it is. The government uses surveys. So they call you up and you're at IBM and I'm at Microsoft and they say, hey, how many employees? And we both say, hey, we both added one employee this month. Could be the same employee. It could just be that I don't have time for the call. We added five. Bye. That they're not doing or let me check the last report. He pulls up some report from 4 weeks ago. Yep, we added 26 employees.
Mhm.
So it's not very robust, and that's why those numbers are revised so significantly in the future. So, and that holds true for many other pieces of economic data. So I think if we had the kind of data we have today in June, July, August, September, I'd be much more comfortable that we can avoid a recession. But I just think it's going to take a little while longer. And, again, we go back to earnings. Earnings were fine, but that was pre-Liberation Day. And we did hear a decent amount of concern or lack of clarity about outlooks. I just a quick story. I was talking to a client of ours who imports, they manufacture goods from China, bring them to the US. Costco is one of their big clients. They sell them to Costco. Costco is so far, this was as of a couple of weeks ago, not placing their Christmas orders yet because they just don't have enough clarity as to what they're doing. This is for Costco, it may not be a big deal to place those orders for those goods, but for our client, it's a huge deal.
Huge deal. Yeah.
And I think, in his mind, he's probably thinking, if I don't get those orders or if they haircut the order from what they typically do, I'm going to have to lay off. I can't, there's a lot of things that we may have to do. And that's the period of indecision I think a lot of companies are in right now.
Right. Right. And yeah, I guess the big question is, is this, like I said earlier, corrosive the longer it goes on, and the more time that goes on, the more or the less economic activity is going to happen this year? Or is the stuff where once we get some, more clarity, the phones can ring and those orders will still spend as much and still have as much economic activity this year? It's just going to be crammed into fewer months going forward.
Well,
We just
and
don't
some
know
of
yet.
it, right, some of it too, we just, an agreement on its own is not necessarily good, right? The agreement could just be that there are going to be high tariffs, and that potentially is not good. So, ideally, at the end of the day, what the best case scenario is that whatever existed before this is actually less. So let's just say Vietnam has a 50% tariff on stuff from us. Let's just say when we have that final agreement, that goes from 50 to 25 and we don't have any tariffs on them. That's a huge win
Yeah. And I
because
think that, to be honest, my one man's opinion, but I think that's sort of Trump's what he's shooting for here is every other country besides China, I just want better. I just want to
Right,
be able to look at what we had before and say we got something better out of them, and we got them on Team America when it comes in terms of putting pressure on China.
right, right. Because
Yeah,
look, at the end of the day, tariffs are a tax. Taxes are an impediment into capitalism, into free markets. And when you have taxes, it's something that reduces productivity, and productivity is what drives economic growth. So if you can, at the end of the day, remove some, you can grease those wheels of the economy, of the global economy, not just our economy, via lower taxes. That's a net win. So that's why I'm saying we just don't know what the end result will be. It may just be a reduction in the tariff, the original tariff, from 60% to 30%, and that's it, which is, in my opinion, it's better than 60%, but it's still a negative. And that's why we just have to wait and see. And of course, every agreement is going to be good by good, service by service. There are going to be so many different layers that I think it's going to be really hard to assess.
right. Well, and that's why they take so long, right? Is when you get to
Right.
the nitty-gritty of the actual contract, you have to have all those line items. One more thing here on the time is not our friend, especially on the jobs market side. So today's payroll number was better than everyone expected. But Torsten Slok over at Apollo, he wrote this, basically warning that, once we get the post Liberation Day data, things are going to start looking a lot more grim. He says in May, we'll begin to see significant layoffs in trucking, logistics, and retail, particularly in small businesses such as your independent toy store, your independent hardware store, your independent men's clothing store. With 9 million people working in trucking-related jobs and 16 million working in the retail sector, the downside risks to the economy are significant. So to your point there, Michael, I think we just, we got to wait another month or two before we really can get a better sense of what's going on here. But time is not on our side when it comes to, that population of what, about 25 million people?
Right. And that's also, kind of circling back to our stock market forecast. That's why we're very tentative at these levels, because I think we're looking at economic data that may not be as friendly as what we've seen. And that may start weighing as the market starts considering that, then they're thinking about how does that affect earnings, and that may weigh on the market, at a minimum, prevent it from going much higher from where we're at today because of the uncertainty.
Yeah, and speaking of earnings, Lance last week put up a chart that showed, S&P earnings for the end of the year, and it was crazy. I mean, he's been talking for weeks about how they're too high and they're going to need to be walked down. But I guess the latest update, at least as of a week ago with S&P, they had revised upwards their
Right.
earnings forecast. So, we have all this uncertainty, all these potential risks for a recession, all those other things that we're talking about. But at least as of last week, it seemed that the analysts hadn't really gotten the memo. What's the story there? Are they still kind of in la la land?
Well, some of the upgrade is because they now have first quarter earnings in hand. So when you're thinking about what are earnings going to be for the year, you're on first base already. And
Yep.
if those earnings were a little better than expected, everything else equal, you upgrade the whole year. But they don't, I think they themselves don't really know what the effect will be, which, every country, every company has a different supply, different country that they rely on. So, Apple's earnings, which may be heavily dependent on China, are different than Nike, which may be heavily dependent on Vietnam and those trade agreements. So I think it's going to be difficult for earnings to try to make sense of their earnings estimates. But I do think they almost have to come down. I just don't see, even if we get agreements, it's hard to see a robust economy, at least, the current quarter and the next quarter.
Right. Well, let's be clear. They're going to come down because they always do, right? They
Right.
always start more rosy and then they get
Gravity.
walked down. The question is are they going to be walked down faster and further than usual? And I'm guessing you think the risk of that is not minimal.
Yeah, I mean, given that they are very high right now, I think that's the risk is they come down a little quicker than they typically do.
Okay. All right. I want to move on to a couple other topics here with the time we have left. One, Michael, is bonds. People are always interested in hearing about bonds in general on this weekly update, but certainly whenever you're on the channel. So it'd be great to get your latest thoughts on them. Let me just throw a couple of topics out there and then let you run with it however you want. So, the bond yields have been quite volatile over the past month, and that's in part because of all the tariff uncertainty. But part of that too, it's heavily believed that there were big funds, like Citadel-size funds, that got caught by surprise when yields moved quickly from 4% to 4.5%, and they are levered something called the basis trade, which Lance explained for this audience a week or two ago, so I won't repeat it here. But basically they were basically having to force liquidate some and unwind some of their leverage positions in U.S. Treasuries, and that was putting downward pressure on prices, upward pressure on yields. So it'd be good to get your thoughts on where you think the basis trade is now. Has it resolved? Is the worst behind us, or are there still worries about that? Secondly, inflation expectations. Bond yields are correlated with inflation expectations. I'd like to get your thoughts on where inflation's headed related to bond yields. And then last, this is a year where the Treasury has an awful lot of bonds coming up for like reissuance. And where are we in that? How far into that reissuance cycle are we? And is that going to put pressure still on upward pressure on yields as well?
So let me start there and I'll work
Work your way
backwards.
back. Okay.
So I think the number is 8 or 9 trillion bonds mature this year and have to be reissued. And there seems to be a lot of fear. I could care less. It doesn't matter because if you think about it, right now there's let's just say the number is 9 trillion. 9 trillion people, they are held by investors. As they mature, those investors will lose the bonds. They will get cash. Those almost all those investors are bond investors. They're money market funds, they're fixed income funds, they're sovereign wealth funds, they're pension funds, endowment funds, insurance companies, individuals that for whatever reason either must hold bonds or prefer to hold bonds. So when you get that bond taken away from you, you're going to naturally buy another bond. So yes, there's 9 billion, but 9 trillion maturing, but there's 9 trillion of people that need to buy bonds to replace the 9 trillion. So I have very little concern about that. You could get, as auctions go on, it could be a little sloppiness, intraday, maybe for a day if the auctions don't go well. But look, at the end of the day, that's never been a problem. It's not a problem. The bigger problem is how much debt is being added to the system, not how much is just rolling over.
All right. Let me
And
just ask a quick question for you to respond to. So I totally get what you're saying. Hey, these people kind of have to or really prefer to own treasuries, and they're just gonna swap the cash they get for another treasury at the next auction. What percentage or what risk do you think there is in the current market environment of kind of leakage due to substitution of some of that 9 trillion? You know what? Maybe I'm going to copy the central banks. I'm going to maybe not roll it into a treasury again, but I'm going to put it in gold. Or maybe rather than owning a U.S. treasury next time, I want to take at least 15% of those proceeds and put those in, some other sovereign debt.
you know what I mean? If you look at the alternatives, I don't think of, I mean, certainly a couple of central banks will do it. But I think when you see a central bank selling treasuries to buy gold, they're not selling their money markets. So these are everything maturing this year by definition is 1 year or under till maturity. So it's a treasury bill, right? It's a money market instrument. Foreign central banks use the money market instruments. That's their checking account. They use that money for trade. They use it to manipulate their currency rates. If they want to make more of a investment decision or security decision, they're going to sell their 10-year bonds to buy gold, 20-year bonds, whatever it may be. So, regular investors, I don't really think are going to trade basically trade short-term risk-free treasury bonds for very volatile gold. Most money market funds, by according to the SEC's 2a-7 rules, have very little ability to go into anything else but treasury bills. So there'll be certainly some slippage, but that holds true. People are getting out of stocks and into bills or into bonds. So there's a little slippage both ways. So I don't think there certainly could be some.
Okay,
And
but clearly nothing that's keeping you up at night.
no, no, that's the lead. There are plenty of concerns that keep me up at night. That's not one of them.
All right. Okay. So inflation expectations.
I continue to stand by that tariffs are not inflationary. That's not to say that the prices of certain goods cannot rise, but in an economy, some goods will rise, some will fall. Some people will substitute. They won't buy the high price good. They'll buy, oranges instead of apples. They will buy the high price tariffed apples and they won't even buy, you know, pick another product. They won't buy steak. So if the money supply is fixed, it's the same amount of money. Whether more money goes into one thing or less of another, it doesn't really matter. It all works out. So, again, the data will be a little different. It's not great until you go back and look over time. But I think what we're going to find is sure there are going to be pockets of inflation in certain goods, but overall the effect will be very minimal. And again, tariffs are a tax on the free markets, on capitalism. So at the end of the day, they hurt the economy, which further weighs on economic activity across the whole sector. So
Which brings down inflation, which
which
brings
brings
down yields.
right. And that's inflation on everything when demand really weakens. So again, I think expectations for inflation will be wide. Some people are in my camp, deflationary. Some are in, we're going back to the 1970s camp. And I think the data could be volatile, could be higher than expected one month, lower than expected another month. But I think the general trend, especially when we go back and look at this, will be lower. And look, the data we've seen, again, it's still not post-Liberation Day. The data we've seen has been PCE was 0%, whenever that was, Wednesday, Tuesday of this week. And CPI and PPI have both been very tame. The inflation data, it's funny, the inflation data that's worrying are the surveys, the sentiment surveys. Those are going
Right.
through the roof, whether it's
Right.
corporate or consumers. But the inflation markets, the break-even inflation, which is based on where people are actually betting on based on tips, are flat. They're not really going anywhere.
Yeah, I think I heard this yesterday that the 2-year yield is now lower than the federal funds rate, which is a sign that the market is expecting that inflation should be coming down over time.
Well, it's also a sign the Fed's going to cut rates over time.
Well, and that's where I'm going next from here. So we'll talk about that in just a second, but just to have you opine on this, something that I've been just trying to make sure people understand is the difference between um, an incremental inflationary trend, like something has happened that is going to make prices sustainably keep increasing going forward, versus a price shock.
Right.
And tariffs tend to be more of a price shock, right? More of a one-time re-rating. Yeah, the price of apples went from, $1 to $1.50, but after that, there's no tariff pressure to get it any higher than that, right? So it's a one-time re-rating. Now it gets a little more complicated than that, but sort of to your point, you see it more as a price shock or a tax where, okay, yeah, we got to pay a bit more. But again, it's not a continued inflate. It's not like the price is then going to rise from $1.50 to $2 to $2.50. And at the same time, that higher price we're paying does cool off economic activity a little bit because there's a little less left over to buy other stuff, and that in and of itself will slow the economy and be a force pulling inflation back to earth.
Right. And this has been a big problem for politicians for the last few years, for Biden in particular. And I think Trump's starting to run into it, that consumers are so focused on the actual price of a good, whereas economists and the Fed are focused on the rate of change of those prices. So if the price of avocados jumped from whatever they are today, say $1 an avocado to $20, that would kill my family. But all of a sudden it's $20. But if it stays at 20 for the year, there was 0% inflation in avocados. But we would all go to the store and say, this is beyond ridiculous that avocados are $20. And I hear it right? We hear it all the time from family, from friends. Everything is so expensive. It is compared to where it was a few years, 5 years ago, but not compared to where it was 6 months ago or a year ago. And that's why sentiment can be poor, but data doesn't reflect it. It's kind of odd, and it's someone in my shoes, it's really troubling because I live both sides of that. I'm preaching that the inflation is coming back to 2%, and then I'm at a dinner party bitching about the price of avocados.
Yeah. All right. Well, look, I do want to get to the basis trade, but real quick, let's go into the Fed first, just because we're talking about uh, interest rates. Um, so the market, as of yesterday, at least when I last checked, was pricing in something like 3 to 4 rate cuts this year. I think even a few more in 2026. So the market expects the Fed to cut. Um, the administration wants the Fed to cut. What has been preventing the Fed from cutting has been fear of inflation, right? And that the job market was normalizing in Powell's words, but to the reporters who were there at the press conferences, hey, this thing looks like it's cooling, right? But now we've got a negative Q1 GDP print. I mean, I know they've dug into the data, so they know the nuances of what's going on. But hey, okay, economy, slowing. Um, they're seeing the same data we are, Michael, that suggests that inflation is going to moderate going forward, tariffs aside. And the latest jobs report, at least on its surface, says, hey, jobs market's just fine. So it does seem that the Fed is getting more and more air cover to say, hey, if the economy really is slowing, we really can start cutting again. So what do you expect the Fed to do from here?
I don't think they do anything this coming week. I think they meet Wednesday. They're not going to do anything. What I expect the two things that I'm going to be paying close attention to, I mean, assuming they don't shock the market with a rate cut, is will they get rid of QT? And the reason for that is we'll talk about that when we talk about the basis trade. That's a liquidity issue. And how will they start to set up the potential for a June rate cut? Because we have heard a few members of the Fed, not Powell, but a few others speaking about they could see cutting rates in June. So
Mhm.
will they make any comments towards the potential or what they need to see to cut rates, whether it's June or August or, whenever throughout the course of this year? So those are from the Fed perspective, the big issues. But here's one thing to keep in mind. Fed funds are still pretty high.
Yeah,
If Fed funds were at 2%, I would tell you the Fed's not likely to cut. But they're still well above the economic growth rate, which impedes economic activity. So we're starting from a different level than we typically have been in the past. So I think it's easier for the Fed to cut without clear-cut signs that we're going into a recession or that the economy is slowing rapidly. So I think I think the biggest problem are the tariffs. The Fed doesn't know how it's going to affect inflation.
right.
And what I don't understand from the Fed is, does it matter? Does You can't do anything about tariffs. You can only try to help the economy after tariffs impact the economy. If the price of cars doubles, inflation will go up, regardless of whether rates are at 4%, 12%, or 0%.
Right.
So
And what you do know is the economy will be injured by that. So better get out in front of it versus being behind the curve.
right, and in a perverse way, the Fed may want to cut rates more if tariffs result in inflation. It's kind of weird to think about it that way, but so I think jobs are what's most important to the Fed right now. And the Fed sees all the data we see, but they also talk to corporate executives. They see a lot of data we don't see. So the Fed has a better indication of the jobs market than we do. And they may be seeing some weakness that's not as apparent in some of the data. And look, there is some data that is showing it's weakening, but it's just not, you know, in everything yet,
Right, right. Well, it's certainly not in the key nominal indicator, which is the unemployment rate. Right.
which is a lagging indicator.
It is a lagging indicator, but how many times has the Fed been ahead of the unemployment rate?
Right.
Zero.
Yep. Yep.
Um, okay, so now let's trundle
So let's
over
talk.
to. Sorry, go
Let's talk
ahead.
about liquidity. We're going to talk
Okay,
about the basis trade.
right.
There's the basis trade, I think, has temporarily been solved. So here's the problem. When you have markets that are highly leveraged, any kind of increase in volatility or decline in asset prices means that more margin has to be posted. Margin requires liquidity. You need to come to the table with more cash. So what happened over, in March was there was incredible volatility in the bond market, in the stock market, currency markets, all kinds of markets. That required more people to post collateral. That drained liquidity from the system. Now, we had talked about this, I think the last time I was on, that the Fed's overnight repo facility was pretty much down to zero. That means that there was zero excess liquidity in the system. There had been a store as high as 2.4 trillion of liquidity that had slowly dissipated over the last few years. So we knew that there was, as the Fed says, ample liquidity, but not excess liquidity.
Mhm.
And when you had all that volatility, it drained it. So the basis trade is the easiest way to see it. The basis trade is so easy. It's so, I'm not going to say risk-free, but it's about almost as risk-free as you get. You're just betting that something that will happen in time will happen, guaranteed. The problem is that the difference between futures and the cash instrument can get worse and could require more collateral and can put you out of business like it did long-term capital. And when liquidity isn't working, people can't go into those easy arbitrages and take advantage of it. So that's what we were seeing. We also saw, and the topic of my article a few days ago, interest rate swap spreads were negative. And that's a topic for a different day, Adam.
Okay.
Yeah, it's already been a while and we don't want to put them to sleep. But bottom line is we're seeing that these derivative instruments are trading at fixed yields that are about 30 basis points lower than a treasury. And that really shouldn't happen either. And the reasons for that is because it requires a lot less liquidity to buy a swap or to receive a 10-year fixed rate on a swap than it is to buy a treasury. And that's another sign that liquidity is, I'm not saying a problem, but it's not as ample as probably the Fed would like. And that's why I think it's very possible the Fed will cut QT or reduce it or do something with it at this
Okay.
May meeting. And if not, talk about it for the June meeting.
Okay. Because quantitative tightening, QT, does drain liquidity from the system. And so if liquidity is not as plentiful as you want, your first step is, well, let's stop the stuff we're taking out of the pool.
Right, exactly. Stop draining the pool.
Yeah. Okay. So it sounds like right now, basis trade, you're not super worried, but of course, the Fed's nuclear concern is a freezing up of liquidity or freezing up of the credit markets. And so therefore, if it were to get worse, obviously we would expect the Fed to get a lot more involved
Yeah,
real
yeah,
fast.
yeah. Here's the key part. We all need to be aware that liquidity is not as ample as anyone would like. So we're skating on thinner ice than we're used to. We
Yeah.
used to be, have you ever seen those shows like in Alaska or the North Pole where they're driving semis over lakes
Yeah.
that are
Ice road
frozen?
truckers. Sure. Yeah.
That was 2 years ago. Right now we're skating on a pond and it's March and it's still the ice seems pretty thick. We're good, but it's we're not driving semis over this thing anymore. And you start to worry that it doesn't take much to fall right through. So that should be in the back of our minds that liquidity is much more dear today than it was than we've become used to, quite honestly.
Yeah, and that's what I wanted to go to with this question. Folks, if you want to really dive deep into liquidity and the importance of what Michael's mentioning here, go watch the last video that I did. I think it was, well, it's probably a little while ago now, with Michael Howell, of Capital Wars, who in cross-border capital. He tracks this stuff really closely all the time. If you watched our spring online conference, you got a really good read from Michael, and basically he's saying what Michael's here is saying is that we had a ton of capital, sorry, a ton of liquidity flooding into the system over the past 2 years, really starting in October of 2022, which is no big surprise when the markets bottomed that year. We've had all sorts of sources of liquidity. He calls it not QE, not yield curve control, yield curve control. So all this stealth stuff going on, in addition to the stuff we could see. There's a lot less liquidity in the system right now. But it's interesting, Michael, like, are we just going more back to sort of like normal? But normal now is so much less comfortable for the system because the system has gotten so used to being juiced by excess liquidity. And sure, we had a ton in the past 2 years, but we also had a ton during COVID. We had a lot, coming out of the great financial crisis with all the different QE programs. Have we just distorted the system so much now that it really has a hard time functioning under what used to be normal conditions?
No, you've added more leverage. Leverage requires liquidity. So the more leverage there is, the more liquidity you need. And when the amount of leverage as a percentage of GDP is increasing, you need more liquidity than the economy is growing. So you need ever increasing amounts of liquidity. It's important, liquidity is this nebulous thing that no one can put a number on. You can't quantify it. Michael Howell does a great job of quantifying it in certain ways, but liquidity is just also what do the market participants want to do? What can they do? If all of a sudden no one wants to buy Apple stock and there's a few sellers of Apple, there's no liquidity. No one wants to buy it, right? That has nothing to do with how many bank reserves there are or what the M2 is or these 40,000 calculations that people make on liquidity. That's just sentiment. If no one wants to buy it, there's no liquidity. And, we saw that in 2008 at times where despite things being AAA, there was no bid, or people had to sell things like gold or treasuries because they couldn't sell anything else. So
Because no
they had
one
to
wanted to
sell
buy
the
it.
most
Yeah.
liquid things. So liquidity, as best we try to quantify it, at the end of the day, is really the willingness of buyers and sellers to transact.
Okay. So a couple just wrap up questions here. So um, I know your expectations are that bond yields will continue to come down um, for a bunch of the reasons we've already mentioned here. Economy slows, inflation gets better under control, basis trade firms up, all that type of stuff. And of course, the administration really wants it to come down. And the Fed might start helping it again, right? The Fed might start cutting rates.
Right.
And we didn't mention this earlier, but I'll just mention it in case we want to talk about it in future sessions. Um, Powell's tenure, we can now begin to see the end of it. It's about a year away. And so you've got other people at the Fed who are kind of auditioning for the role to replace Powell. And I think that could be some of the reasons why some of the members of the FOMC are getting more vocal about wanting to be more dovish, right? Trying to show Trump, hey, I'll be your guy there that, is willing to listen to you a little bit more than Powell seems to be. Um, so lots of reasons why hopefully rates come down. I think in most cases that's going to be beneficial to the most players.
Hmm.
But it might not happen, right? And that's been one of the administration's frustrations so far is that bond yields have been so volatile. So, Michael, um, if they were to go up, not down, I've heard that sort of the nuclear line in the sand is like 5%. Is that where the economy really starts to really have some trouble? And of course, government paying its servicing its debt interest expense, that really gets really big. So, do you feel similarly that that's kind of, the real worry point? And if so, if we were to get there, what would happen? Do you think the Fed would go back to QE?
You know what? I think a lot of games can be played here. For instance, we're hearing now that Japan is potentially considering using treasuries as part of their tariff negotiations. Might that be what every country does? Instead of tariffs, we'll buy 10% more treasuries, or we'll do this or that with treasuries. So, you know, the tariff agreements can help the market. There's some regulatory problems that if they change the capital rules on the banks, could free up a lot more room to buy treasuries. Those kind of tools could be used. That's kind of more on the regulatory, kind of presidential side. The
Sure.
Treasury Department could do something like an Operation Twist. There are tools they can do. The Fed can do an Operation Twist. The Fed could do QE. I doubt they would. They've continually said they're not going to do QE till rates get to zero. But so I think there's a lot of lines in the sand. But at the end of the day, if rates get back to 5%, my guess is the stock market's exploring new lows, liquidity is failing, and the Fed will have to come to the rescue, which will just lower yields naturally. So, can we get to 5%? Sure, anything can happen. But I think there's a lot of pressure on the president, on Scott Bessent, on Wall Street to keep rates where they're at or lower.
Okay. Yeah. It sounds like, again, it's not a risk you're really lying awake at night about right now. You're feeling more confident that rates will stay or march lower.
Yeah, and look, if I'm wrong on tariffs and tariffs are very inflationary, then, we'll change our tune. But right now, we continue to, keep in mind, Adam, that the 10 years down about 40 basis points in yield this year, and 2 years are down even more, I think 50 or 60 basis points. So it's been the same roller coaster the stock market's been on, but it's kind of been one that's kind of up and down, but declining in yield.
Okay.
So it's just hard to see it with all the volatility.
Ability. Yeah. Okay. All right. Well, look, as we start to wrap up here, let me just do a thought exercise with you. So, you know, this is a very uncertain period of time. A lot of it is intentionally created uncertainty, right? The administration is doing a lot of intentionally disruptive uh, practices and policies right now. And as Treasury Secretary Percent, is saying a lot on TV right now, he's like, hey, and a lot of this is intentional. He's like, it's part of the president's negotiating strategy. It's manufactured uncertainty to keep, your opponent guessing. And he's using that as a sort of a weapon in these negotiations, right? Now, whether that's true or just Bessent trying to put lipstick on a pig, we don't know yet, but we'll find out. But let's just assume for a moment that the administration is successful and the key pillars it's working hard to put in place right now. We get the better trade deals with all these countries that we want, right? Including China. We stimulate growth through tax cuts and deregulation and attracting more foreign investment here into the country and creating a renaissance, reshoring our manufacturing capacity and creating a new manufacturing renaissance here. We get fiscal spending better under control through things like DOGE and continuing resolutions and things like that. So if they are successful, we should probably start seeing at least the initial green shoots of that by the end of this year. And then, over the next couple of years of the Trump administration, it could be a pretty big tailwind, I imagine.
Huge.
So let's assume for a moment that the administration is successful. What does that do to your investment outlook?
Stocks go significantly higher in the longer run. Again, later this year, next year, maybe even the year after.
Yeah.
It's actually funny you bring that up because my article even though I'm still writing the article, I have a title and it's The Storm Before the Calm. And
Mhm.
the calm being all the potentially good things that Trump can introduce to spur the economy and ultimately stock prices. So, yeah, I think that's where you have to be really careful. It's very easy to talk about poor liquidity and tariffs going awry and that China and the US are going to stop trading with each other and recessionary and depressionary type outlooks. And I can make a case for a depression, a recession, a kind of just stable growth, but I can also make a good case that this is a good buying opportunity for years to come. So
So, so again, and right now I'm just asking you to project yourself in the rosy outcome here, right? So, do you expect sort of a Reagan era, resurgence of above average growth, and that would lead to outperformance in the stock market? So, as investors, we could look to, hopefully getting into companies at decent values later this year, and then riding, a multi-year trend up from there.
now keep in mind, in the early 80s, PEs were in the high single digits.
Right. They had a lot, yeah, a
They're
lot
they're
higher
still
upside.
well above normal today. So we're not going to get the Reagan-esque type potential powerful rally because you're just starting at much higher levels. But I think we could have sustained bull markets.
Right. And also too, I mean, you're talking average PEs, right? There may be sectors that could benefit really well from what's going on that are more attractively priced today too. So you could get maybe some Reagan era performance in select sectors if you're a savvy, active manager here.
Which is always true. Yes. There's always deals and there's always stocks that are way overpriced.
Okay. All right. So now let's take that hat off. Let's put on the darker hat, right? Let's say all this stuff just, forgive my language, just screws the pooch, right? We have angered all of our trading partners. We drive them further into the arms of China trade wise. None of these big deals makes it through Congress. We don't get the tax cuts. Maybe even we don't get the extension of the previous tax cuts. No deregulation progress. Doge just shuts down in ignominy. It doesn't really lead to any savings. How bad could things get in that future?
It could get pretty bad. I mean, I think we could talk about the S&P at the 4,000-ish, maybe even below there. Using fundamentals, using kind of technicals, you can certainly make that case. I mean, even just, getting down to 2,200 levels, you get into the low mid 3,000s. That was only a few years ago. So, that's also an easy case to make. And I think one thing to consider is that all those rosy things that Trump's called Trump's Trump card that helps spur economic growth, if he loses the House or Senate, forget all that stuff. Not much of it can be done with executive action. So the risk is that this just lingers for a year or two and he loses the House or Senate and that rosy, the calm, the whatever you want to call the scenario becomes much less bullish. Um, but again, there is a lot of downside because we're at high. So in the early 80s, the downside was so limited because we were so cheaply priced. It's
Right.
the opposite now. There's a lot more downside because of that. So,
Right.
this is it sucks, but this is a way of saying the future is this huge wide range, which it always is. But I think it's just being brought to the limelight now because Trump has kind of introduced this new possible set of scenarios that are both very bullish and very bearish.
Right. Well, so a number of folks I've interviewed, and Felix Zulauf, comes to mind first and foremost, are saying they expect your middle of the road outcome you'd put up there on your chart going to be volatile until, say, the fall, when things firm up. So, he's basically saying your priority right now is just to build dry powder, right? So if you want to nibble on the dips, feel free, but really it's about just keeping your powder dry until things firm up. And I think there's a lot of reasons why he thinks things would likely firm up, but we should know by fall a lot more about how the trade deal is getting resolved. Did Trump's big, beautiful bill, on taxes and stuff make its way through? are the deregulations making their way into legislation? So we'll have a lot more clarity on that. And to your point about the risk of losing the midterms, I totally agree that if the economy isn't showing upward momentum by next summer, so a year from now, um, he'll probably lose Congress, right? It's just the way these things tend to go. And I believe that's why he's scrambling so hard this early in his term to get all this stuff passed, right? So let me ask you this, Michael. Even if he loses Congress a year from now, or a year and a half from now, if he's gotten all this stuff passed and enacted, is that enough, right? If as long as Congress is gridlocked, meaning it can't undo it's not going to do anything, but it can't undo anything either. If he gets all this stuff front loaded and going, is that still enough to potentially, have good outcomes?
Yeah, absolutely. But keep in mind, he can lose Congress before the election. If the Republicans are scared they're not going to get reelected because they're associated with Trump, they think is screwing up the economy,
Right.
he's not going to get those votes now. They're going to have to separate from Trump to some degree and vote against some of that type of legislation potentially. So it's not just a 1.5, 2 year thing that we're looking at. This is a now thing. How will all he has to do is lose, not that many voters. And it's so close. It's not a firm majority. So that's, I think, where Trump has to be careful, is not to lose the votes from the Republicans in the House and Senate right now.
Yeah, no, I agree with you. And I think this is why getting these memoranda of understanding is actually really important in the near
Hmm.
term. He's got to start putting some wins on the board, I think, to keep his base of Congress people, willing to keep their necks stuck out right now.
Right, right. I think that's his first order of business.
Yeah.
And I think he should probably leave some of the other stuff alone for now and just focus on that and get some deals done. Because that's clearly what's problematic for consumers, for the politicians, for corporations.
Yeah. Now, what's interesting is look, I could have made a great argument, and I'm happy to still make it, that the economy would enter recession at some point this year, even if irrespective of what Trump's
Hmm.
economic policies were, right? Just with what he
That's fair.
inherited, right? So, I think to a certain extent, there's going to be some challenges with growth this year for a whole bunch of legacy reasons, let alone other things that are being added to it in the interim. So yeah, I think he's just got to put enough wins on the board quickly enough to keep enough of his congressional supporters to get these bills passed. And then, of course, we got to cross our fingers. The fact that they're passed doesn't mean they're actually going to achieve the results that were being sold. So, there's still a lot there. But I guess boiling it all down for the investor, it does seem to be a lot of sense to do what you guys are doing, which is to just be a little more conservatively deployed, a little more patient with the markets, saying, hey, while there's a storm here, we're not going to be highly speculative. We're not going to be terribly long. We'll hunker down a little bit, and then when it blows itself out, that's when we'll start getting a little more aggressive.
And the other thing I think is very, very important, Lance and I have written way too many articles on it and on behavioral instincts. And I was talking to Lance and I just wrote one a couple months ago, and I did it for me to remind myself. And Lance goes, that's funny. I do the same thing every once in a while. And I think what's most important is to understand your behavioral traits. And more often than not, they work against you. When the market was at the lows, we were just as fearful as most investors. We just had enough confidence in the ability of our rules to help us manage through that period and not dump and wait for the bounce, which is what we did. And then as the market started rallying, we methodically, slowly started reducing our exposure at much higher prices. And so you know, I guess my advice is be a little conservative here. We're on thinner ice than we're used to, and understand those trades that will get you at exactly the wrong time. Just like when a market's hitting new highs, everyone wants to jump in, right? And it's the opposite. Understand those traits and how they work against you and develop a set of rules that you can follow that help you sleep at night when markets otherwise wouldn't.
So I'm very glad you mentioned that. It's reiterating a point that we make on this channel a lot. Lance and I talk about it a lot, is that in many cases, as investors, our own worst enemy to our long-term success is ourselves and really
Right.
our emotions, right? And this is one of the reasons why I tell people, look, the most important thing you can do, best advice I can give you is just to be honest with yourself
Yes.
around what type of investor you want to be and how well do your skills map to the type of investor you want to be, right? And if you are an experienced DIY investor who knows how to invest through volatile times, fantastic. It's a great market for you to lean into those skills, right? What percentage of people watching this video do you think meet that criteria, Michael? Very
Very,
few,
yeah. And
percentage-wise,
that's
right?
including professionals.
Yeah, yeah. And so, if you're just a regular person, you're much more likely to be ill-suited to be, managing your portfolio anyways, because your expertise has been developed in other areas, your job, other types of things, right? That, right? So, first and foremost, you could ask, look, am I going to be the DIY person or am I going to leverage a professional? But either way, what you want to do is you want to have some things that are protecting you from your base evolutionary wiring that may be working against you here. And one of the great things about working with a good advisor like you guys is you guys have a rule set, right? So first and foremost, you want to have some sort of rule set that guides your decision making so that you're not just doing it off of emotions
Right.
or constantly in reaction mode. Secondly, you guys have experience. You guys have decades of experience doing this, right? So you've got a lot of history to draw on. Hey, I know in the moment this feels really freaky, but history shows 8 times out of 10 this happens, and so we're gonna ignore the emotion and we're gonna stick to what history tells us is going to happen. And then third, it's just a reality check, right? So if I'm an investor and I'm saying, wow, I'm feeling really motivated to do X, Y, or Z, a good advisor will say, okay, we could do that, but convince me, right? And once you force somebody to get out of the emotion and start talking logically, oftentimes the right decision becomes really clear. And without that reality check, you're just making a decision based on emotions. So anyways, I very much appreciate you underscoring that because that's probably the single greatest saboteur that I see of people's long-term success over time.
Absolutely. And that's why Lance and I both preach the active approach is much better in the long run. Doesn't mean you're always going to win the day, but it means that you can protect yourself better, you can follow your rules better, and a lot of times you can sleep at night better during some of these rough days that we've had. Let Lance and I stay up all night worrying. You guys go to sleep.
I mean, I practice what you preach. As I tell people on this program a lot, the majority of my financial worth is managed by another professional. One, because I do like to sleep at night. I like to let them do the worrying, but I also know that they've just got a better skill set to do this than I am. My skill set is media production and having these conversations. And one of my biggest failures is I will get real motivated to buy something, and I'll go if I let myself trade on my own, I'll go buy it, and then I get so busy with doing all these different interviews. A few months go by, I look at my portfolio, and I say, why the hell did I buy that thing, right? I don't know
Right.
why I own it. I don't know when to sell it then because I don't know why I bought it, right? So it's so much better to just leverage the skills of somebody who is full-time focused on that. All right, well, and I'll tell folks in a moment if they want to go have a conversation with you and your firm, Michael, how to do that. Before we do, though, can you tell us what trades you guys have made, if any, over the past week?
We added, I believe it was Wednesday. Could have been Thursday. These weeks feel like they're 10 days now, so I
I
don't even
know.
know which day is which. I think it was Wednesday. We added another 1.5% to our short S&P 500 exposure, which brought us to the 45% from 60. So right now we have 5% short exposure in our portfolio. Um, I believe that was the only trade we did this week. We did that in both models.
Okay. And so that's telling. It's more validation that you do think that markets are more likely to roll over from here. But I'm assuming, as Lance said, he's happy to be wrong, meaning, happy to lose money on the shorts because it means the bulk of your portfolio is actually appreciating, right?
Right, exactly. That's
Yeah,
right.
and that's folks, that's the benefit of hedging, right?
Hmm.
You hedge, and just like you buy fire insurance on your house, you actually hope you never need to use it. But if you do need to use it, boy, you're glad you have it, right?
Right. And you want to buy fire insurance when it's in the dry season, not when it's raining every day.
Right.
And we're in the dry season, so get some insurance.
Okay. All right. Well, look, in wrapping up here, I'll try to do a real quick rant with you, Michael, and then let you go. First, Lance and I did a rant last week, which I knew was going to be a little bit probably sensitive and potentially triggering for some folks. And I was happy to see that in terms of the folks that were triggering, it was about 50-50 on both sides of the spectrum. So we were talking about, uh, you know, a need for a cultural focus on family formation, that we just make it so hard for our younger generations to actually procreate here. I mean, there's a societal, almost existential risk here. I got a number of comments that were saying, "Oh my God, Adam's gone, full-blown MAGA." And I got other comments saying, "Oh my God, Adam's a socialist. I didn't know." So I think that's a sign that I'm hopefully preserving my independent, middle of the road, moderate, apolitical approach, which is my intended approach here, and it really is sort of how I am. Yeah, I'm sorry if you were one of the folks I triggered, but it looks like it was an equal triggering opportunity here, and I think it was an important discussion to have, and I appreciated all those who weighed in with their ideas on it. Hopefully this week's will be a lot less triggering. I talk a lot on this channel about developing self-understanding, and look, when I was very young, I mean, basically from my earliest memories, my parents had gotten divorced. My mother raised my brother and I. She had custody, and from day one, it was not only are you guys going to a good college, not only are you guys going to Ivy Leagues, but it's you guys are going to Harvard. And my mother, I think she went to a junior college. I mean, it wasn't like she was incredibly credentialed academically, but she just had determined education is going to mean success. My boys are going to be successful. You guys are going to Harvard. Um, and my brother did get into Harvard. I did not. I got waitlisted undergrad. And in my mother's eyes at the moment, I had ruined my life.
Failure.
Um, I will fast forward and say when it came to graduate school, I did get into Harvard and had the great pleasure of turning them down just because
Even
payback's
better.
wonderful. Yeah, payback's great for karma. Um, but really what I learned from that when I became a parent was I did not want to do that to my kids. Not only did I not want to put the pressure on it for my kids, but my whole academic upbringing was really all about studying to get the grade that's going to get me into Harvard and do the things for my, you know, resume that were going to get me into Harvard. And there was not really much self-reflection in there of, hey, what's going to make me happy? What do I think I want to do with my life, right? And there really was no plan beyond go to Harvard so you could do X. It was just go to Harvard. Well, I was going to go to Harvard and be a doctor, but um, but there really was never any question there about like, is that a path that was going to make me happy? And so, anyways, long story short, when I had children, I told them, look, I care much less about the grades, and I care much less about the brand of the school that you go to. I don't even care that much about the college that you go to, or if you go to college. What I care about is that you're developing the self-understanding that is going to help you identify and map your actions to the thing that's going to bring you, the most joy and success of whatever success you want to have in life. So really, in your younger formative years, do a lot of introspection, a lot of self-exploration, understanding, so that you know how to navigate life as you go out into it. Because like when I didn't go to Harvard, but I did go to Brown, another Ivy League school. And I really kind of struggled there for a long period of time. One, because Brown is one of these schools that prides itself on, we have no requirements, there's no core curriculum. You can design your exact best educational experience here. Well, I got there, and since I didn't know where I wanted to go, I didn't know how to assemble the blocks. I didn't know how to use them well. It's a great school, don't get me wrong. It just wasn't great for somebody who was as immature as I was at the time about what I wanted in life. So,
Mhm.
anyways, I've been, real big on self-understanding, and I've talked with folks on this channel about some of the tests you can take whatever age you're at. But one in particular, the Johnson O'Connor test, I think every 17-year-old in the world should take that test. It's great information you can leverage your whole life long. The reason where I'm going with all this is I had an experience recently that was related to this that I think there might be some learning potential here for the audience. Um, I have been working out at home, a pretty aggressive workout program, and got to the point where I was really beginning to get injured, and needed to take some time off. Suspected that I was probably overtraining, and also realized there's probably some blind spots I have in my form on some of the lifts I'm doing that are probably need to be fixed. So I started going to a personal trainer. Sure enough, he identified some pretty big things I was doing wrong and some key lifts, and that's been great. We brought the weights down for a while to give my body some time to recover. It's now the weights are going back up again. It's feeling pretty good. I'm getting strong. I've got the right form now this time, so it's all good. But one of the things that he noticed about me is he said, "Hey, how much are you eating?" And I told him how much I was eating, and he said, interesting, because he's like, "I think you're eating way too little. If I look at your body type, you've got a wide trunk. Like your body is designed to be big, to be bigger than you are right now." And I'd spent so much of my life because of my wide trunk trying to be really trim, right? You want to try to get that V shape or at least a rectangle shape, right? And so I kept focused on trying to keep my trunk as trim as possible. And he's more like, why don't you just let your trunk be your trunk and try to just get big everywhere else, right? I think that's what your body really wants to do. So we've been leaning into that, and I mean, it's early days, so I don't know exactly where this is going, but it kind of has the feel of like, I don't know, a plant that was planted in the wrong soil for it. You really needed some rich, moist soil, but you were in kind of a sandy,
Right.
environment, dry environment. Um, and so it's a bit of self-awareness that I didn't have before that I may have now. And who knows, but I'm kind of feeling like I'm in this process of stepping more into kind of who I just was sort of born to be in many ways, just
Right.
genetically. So anyways, I'll wrap it up here, Michael, but I guess maybe the moral here is just obviously the more authentic we can be in how we live life, the better it is, the more happiness and joy we get out of the experience. But that all comes from having to have the self-awareness and self-understanding. And so, we should spend more time doing that, really introspecting, whatever. But by definition, we can't see our blind spots. So sometimes we need to go solicit an outside perspective on us, looking at us with fresh eyes or looking at us with expert eyes. And, financially, that could be having a financial consultation with somebody like you who can say, hey, these things you're doing great, but these things here don't seem to be working in your interests. But it could be with your physical body like me, it could be going to a doctor to get an assessment. It could be talking to a third party just about how you come across socially. I mean, there's so many other different ways to benefit from this. So anyways, I know you're a guy who's into self-development, so I'm curious to hear your thoughts.
I think you're right. And I was, as you were kind of talking about you potentially going to Harvard and all that, I was thinking about my kids and how do I raise my kids? And what I've always focused on them is to be yourself, do what you want to do, you know, not necessarily be successful from a monetary point of view, be successful from a self-fulfillment point of view. So my youngest son he actually just finished his junior year at the University of Florida. And if it's up to him, I think he would live in the jungle studying, leaves and carbon, the way carbon goes through the water system, which is what he's doing now, and so many different things. And we're encouraging that. We're encouraging, look, you're going to have to pay your own bills and take care of yourself, but figure out a way to make yourself happy, to fulfill your needs, to understand what you are and what makes you not just happy, but drives you and pushes you to success in whatever field it is. And, so far, like I have three kids, they're all doing really well. Two are actually in the job force and not living at home, and it's great. And they're making money and paying their bills, and they're happy, and they're kind of doing what they like doing. So, I think the lesson is to understand who you are. It's kind of like what you were saying. Understand who you are and what makes you the best person. And it's not money. that makes you the best person. It's that fulfillment that you're doing what you like doing, that you're doing something good, that you're helpful to others, that you're mindful of what you need and the type of person you need to be, whether it's a bigger guy than you are, Adam, or maybe, smaller, whatever it is. So
So it's I mentioned this a lot in the channel, and I just can't remember if we've actually ever talked about it, Michael. But the research is pretty clear. Money is it's not an end, right? The goal is not to die in a room with stacks of cash piled all around you, right? The goal is to have a good, fulfilling life, right? And money can certainly be a great catalyst on that journey, but it's not the end destination. And the things that really matter in life, research is really clear on. It's quality relationships, because at the end of the day, we are tribal animals.
right.
Um, it's meaning or purpose, right? That our days have value in some way that's meaningful to us. And then it's health, right? You can't live a long life if you don't have good health. And so we're really talking about the whole meaning part here, right? And, as somebody who's worked lots of different jobs, worked on Wall Street, worked in Silicon Valley, had really quote unquote good, high powered, respectable jobs. If you don't like what you're doing, no matter what they're paying you,
You're wasting
it's pretty
time.
miserable. Yeah. And, I remember right before I made my huge life shift, uh, I was a VP at Yahoo after having worked on Wall Street and got an MBA from Stanford and yada 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 yada. And I remember driving home thinking, if I were to get in a car accident right now and my life flashed before my eyes before I died, I would be so disappointed in this movie. Even though somebody would look at my resume and say, "Oh my God, this guy was killing it." Like I personally would have been so disappointed in that. And so I know firsthand that if you enjoy what you're doing when you wake up in the morning, regardless of what return you're getting financially on it, I mean, you need to get some base level, right? Below a certain amount, yeah, life gets real hard. But if you're above that base level, if you enjoy what you're getting out of bed to do every day in the morning, you're winning life. Like that's really all that matters. And the irony is that if you align your behavior to do things like that, where you are excited and motivated when you get up, the money is more likely to follow because
Yeah.
you're likely to outperform because you're doing what you love versus everybody else that's doing the same thing because they feel they have to, right? And then the market will find you and reward you for your passion and your talents and all that stuff. So, no guarantees in life, but your probability for financial success actually goes up the more you align yourself with alignment of mission. So, anyways,
Real quick,
yeah,
Adam, can I just add one thing? I know we've gone
please.
pretty long here. So I'm going to get you the name of this guy. I can't remember it offhand, but he wrote a book and I think it's called Die with Zero, something like that. And the gist of it was that the guy made a fortune trading something in Chicago, trading beans or some commodity. I forgot what it was. And he amassed a huge amount of money to live off for the rest of his life. And over time, he kind of came to this conclusion that he wanted to die with zero. And that's and not in a selfish way, not where I'm just going to buy 5 mansions and luxury cars and fly around the world on glamorous vacations. I'm going to use that money to spend time with those people that I love the most and to do things with those people. So every year he takes 20, 30 friends on a vacation somewhere and spends the time with them. And you're giving the money away, whether it's to family, friends, whoever you would give it to anyway, but you're enjoying the time with them while you're giving it to them, as opposed to them getting a lump sum of money when you're dead. So I'll get you the name of the guy. Maybe you can even bring him on because I think it was just a great way to think about life.
I've actually heard of the book. I've not read it. So thanks again for really forcing me to make a commitment to read it. But I'll read it, and if it resonates as much as it sounds like it will, I will reach out to that guy. That'd actually be a great perspective to bring to the audience here. All right, Michael. Well, look, I appreciate you going through that journey with me. I do think at the end of the day, folks, money is great, but as I say to you all, my wife's a therapist, and we live out here in the Bay Area. A lot of her clients are pretty wealthy, and it's shocking, Michael, how oftentimes more money just means more problems for
Mhm.
people. It is not the path to happiness in and of itself, right? So, you want to keep your eyes on the prize about the things that really do matter. All right, folks. Well, look, if you know, one of the things that matters to you most in life is watching this weekly market recap with Michael and Lance week after week, please let them know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you want to talk to a good professional financial advisor who can help you navigate, you know, both this sort of volatile road ahead that Michael and many other folks I interview think is likely to happen for the next couple of quarters. You know, if you've got a good financial advisor who can navigate you through that already, great, stick with them. But if not, consider talking to one of the financial advisors that Thoughtful Money endorses, perhaps even Michael and Lance and their team there at Real Investment Advice. To do that, just fill out the short form at thoughtfulmoney.com. Only takes a couple seconds. These consultations are totally free, and the firms will reach out as soon as you fill out that form. Michael, it's been great, my friend. We got to do this more often. Got to let that Lance guy take more trips away like he's doing this week.
Yep.
But I'll let you have the very last word here. Any parting bits of advice for folks?
Just buckle up. It's going to be very volatile. Doesn't mean we're going higher or lower. We could end up where we could be in October at the same place we are today. So just kind of keep your wits, understand what you're good at, what you're not good at, and you know, just pay close attention to what a lot of people say, digest it, and make the most of, you know, of so much information available to you.
All right. Who was it? Betty Davis? Was she the one who said, "Buckle up, boys. It's going to be a bumpy ride"?
I don't know.
I
Could
can't
be.
remember. Folks, I'll try to figure it out for next week, unless folks you know, and you can put in the comment section below. But great counsel there, Michael. All right, my friend. Thanks so much for being on this week. We'll have you back on the program again soon. Everybody else, thanks so much for watching.